All right, if you've been in the dividend income investing world for any amount of time, you've definitely come across a ton of articles like this. 8 reasons why I'm not a dividend income investor. And they usually talk about how income investing doesn't actually give you income. They always regurgitate the same couple points like taxes, total returns, and things of the like. In fact, on my latest video, I got a comment by Thomas talking about how the article I was reading on dollar cost averaging had a blurb in it about how income investing isn't ideal. So the plan for this video is to go through the main points and debunk them one by one because honestly, these articles are full-on misleading and I think they're quite dangerous. Investing isn't a team sport. I'm not a dividend aficionado, whatever that even means. If I come over to my portfolio, I invest in both dividend and growth assets because they're both a great avenue to make money. And I've said this multiple times on the channel. I invest to make money, so the total return is the single most important thing to me. And articles like this that use a broad brush, they're designed to appeal to the lowest common denominator. So like this first result, taxes. Taxes are bad. It's super basic and it's wrong in so many ways. Once you do a little bit of research and educate yourself, this is complete nonsense. Okay, so there's usually 3 main points against dividend investing. First one is taxes. So let's go ahead and debunk this one first. So people always say that dividend investing is very inefficient when it comes to taxes, right? That's the argument. So when it comes to dividends, there's 2 kinds of tax rates. There's qualified dividends and non-qualified dividends. And qualified dividends are taxed more favorably. We can see here that it's usually at a 15% tax rate, depending on the tax bracket. And non-qualified dividends are taxed at the ordinary income rate, which is progressive and based off of your income. Now, the first thing I want to point out is these zeros here for the qualified dividends. So if you make less than $80,000 per year, you pay 0 on qualified dividends. And let me throw some numbers at you. So we're on the census.gov right now, a pretty reputable website. And this is the income and poverty section. So it says per capita income in the past 12 months in 2019 dollars is $34,000. So that's the per capita income in the US. And the median household income is only $62,000 per year. So if we come back to this, less than $80,000 per year, you pay 0 on qualified dividends. And qualified dividends are the most common for blue chip US dividend companies. So considering that, plus the fact that most people make less than $80,000 per year, most people aren't gonna pay a dime in taxes on their qualified dividends. Again, the per capita income is $34,000, so even non-qualified dividends, we're talking a 12% tax rate. Now, I'm no tax professional, so definitely talk to an accountant if you have questions on this, but the whole tax thing, I think, is way over exaggerated when it comes to dividends. So let's go ahead and cross that one off. That first reason, taxes as being a reason not to invest in dividends, is complete nonsense. Now, the second reason people always quote is yield chasing. And this is a legit thing and something I warn against on my channel all the time. So chasing yield is simply going to your brokerage and filtering by like 8% dividend yield and picking a random company because it has a high dividend yield. And of course, that's not the way you want to invest. I don't think I have to explain why that's a bad idea. But that logic of investing in a company because of one single metric, that applies to any investing strategy. In fact, I would say the equivalent of yield chasing for growth investors is chasing price appreciation or lines that go up and to the right. So this is the chart for Bitcoin, and down here is the volume. And this applies to any asset, not just cryptocurrency, but the behavior is as following. When the price begins to skyrocket and go up, and all of a sudden it costs 3 times as much to buy the same share as it did a few weeks ago, that's when all of a sudden people are buying it. They're chasing the price appreciation, buying in up here, even though most of the gains were already had. And then, of course, when it comes all crashing down, and it's cheap, and this is where you should be buying it, the volume is almost non-existent. So single metric things like yield traps can be applied to any investing strategy, not just dividends. And that's why myself, along with a lot of other creators, make great content on YouTube about how to properly research companies. You want to look at things like the payout ratio, make sure it's low and healthy. Also, things like the financials and the total revenue of the company. You want to buy an asset that is increasing the revenue year over year, so that way it has price appreciation and it can grow over time. So the basic fundamentals, and this is true if you're investing in dividends, small cap, large cap, growth, it doesn't matter. So yield chasing as a reason to completely avoid investing in any dividend company is also completely false and misleading. Now, the last one is subpar total returns. People say that dividend companies, they're usually large, old companies, their heyday is behind them, and because of that, they lag the market and have awful total returns. So if you've been watching my channel for a while, you're probably familiar with this. And this is a total return chart because, again, as an investor, the total return is the most important thing to me. So this is SCHD, a dividend-focused ETF, and we always have to compare it and benchmark it against the S&P 500, which is the general market. And we can see here that over the past 5 years, they've been in line with each other. In fact, if we zoom into just the past 1 year, SCHD, the dividend ETF, has outperformed the market. That is great total returns. So again, this notion of dividend companies not having great total returns is something that appeals to the lowest common denominator. It's a broad brush kind of statement, and it's completely wrong. It's not as simple as dividend companies underperform and growth companies always overperform. In fact, you know what? Let's do some comparisons here. So SCHD is right in line with the general market. Now let's introduce a growth ETF that has underperformed the market. EEM. This is an emerging markets ETF, and people invest in this because they think these markets are going to outperform. So if we add this line, we can see that it has underperformed the market, while the dividend ETF has overperformed or at least met the market. And of course, to be fair, there are dividend ETFs that have also underperformed the market. One that I really don't like is SPHD. I just think the underlying companies in this ETF are trash. It just depends if the underlying asset itself is creating value in the marketplace. That's really what it boils down to. And whether or not it's a growth, small cap, dividend company, that doesn't dictate in and of itself the performance of that company. So I'm going to go ahead and cross this one off. Again, it's a complete falsehood. And you know what? While we're on this topic of total returns, let me explain how I view total returns. So to me, total returns is a spectrum. On one side of the spectrum is all price appreciation, so growth companies. And on the other side, we have more dividend companies, which give you a total return in the form of some price appreciation and some cash flow in the form of dividends. And as investors, we can choose where on the spectrum we want to receive that total return from. Do we want more dividends and cash flow in our portfolio? Or do we want to be more speculative, take on more risk, and have price appreciation? But no matter which way you go, the total return is always the most important thing. And you know what? Dividend investing actually has lots of benefits that other investing styles don't have. So this article says the best hedge against inflation is dividends. The stock market maintains value even when the dollar doesn't. And that's true no matter what investment, but I like this chart down here. This shows the S&P 500 over time. This top line here is with dividends reinvested, and this bottom line is excluding dividends. So we can clearly see the role that dividends play in total return. But inflation is a huge concern that a lot of investors have right now. And if we come over here, inflation is usually around 2% per year. And in 2021, it was 5.4%. So a big spike in inflation as of recently. And dividend ETFs pay around a 3% dividend yield depending on the ETF itself. This is SCHD. But the most important thing here when it comes to inflation is the growth rate in that dividend. So in 2017, the growth rate in that dividend was 7%, 19%, 17%. So that growth in your dividend payments is easily outpacing inflation even when it spikes like it just did in 2021. And this is a property that growth ETFs simply do not offer. So we're looking at ARK Innovation ETF right now, one of my favorite ETFs. And we can see that back in February of this year, this ETF spiked. And guess what? The growth investors were chasing the price appreciation. A lot of people are buying in up here that lost a lot of money. So if we're going to be judging investment styles off of one metric, this is a huge downside of growth investing if you want to look at it that way. But regardless, since then it has come down a lot in price and has moved sideways. So one way of viewing this is your money is sitting idle, going sideways, while inflation is going up, taking away your buying power. There's no guarantee that growth ETFs are going to grow all the time, but dividend ETFs constantly pay out a growing cash flow over time. So that's my rant for today. I just wanted to debunk these reasons for why dividend and income investing isn't good. This stuff is clickbait, it appeals to the lowest common denominator, and it's completely false. Once you educate yourself a little bit and do some research, dividend investing can be a great way to make money, and that's why I invest in both dividends and growth. There's downsides and risk to any investment strategy, whether it's domestic markets or overseas markets. The most important thing is to always be educating yourself and make solid investments into great companies that have the potential to grow over time. And whether or not the company pays a dividend doesn't affect that. The only thing it affects is how you receive the total return. Do you want more cash flow or do you want more price appreciation? It's up to you. But that's the end of the video. I hope you guys enjoyed. If you did and you're still watching, give the video a like, subscribe to the channel, and I will see you in the next one.